Good morning everyone and welcome to Port Jackson Securities webinar. I'm Aidan Lane and I'm here with Kevin Ball from Whitehaven Coal. Kevin is the CFO over at Whitehaven and he's sitting down with us today to discuss Whitehaven Coal's outlook for the next year and their solid performance across the last 12 months. How are you today, Kevin?
I'm really well, thanks Aidan. Thanks for having me and thanks for everybody for making the time today to come and listen to the story. Looking forward to it.
No, that's great. So Kevin, just as we get into it, could you just give me a sort of a brief background about what you sort of do at Whitehaven Coal and how you've come to Whitehaven Coal?
Sure. The role at Whitehaven Coal is called Chief Financial Officer, but it's a little bit more than that. I've got procurement that reports into me, IT that reports into me. For a while I looked after HR, which some question, but that seemed to go okay. I've got Sarah McNally reporting to me in business development, in investor relations and business development coming to me. And on top of that, I've just got the regular financial materials. So I'm kept fairly busy. I've got a great team of people around Newcastle and Sydney, and we're really, it's a solid group of people in a business where people have an ability to make a difference. So it's quite good.
Yeah, sure. And where are you sort of dialing in from today? Are you in the head offices for Whitehaven, or?
I'm in the office of Whitehaven. It's a beautiful day in Sydney, and there's about 5 of us in the office at the moment, so it's really quite useful. Paul comes in, I come in, the head of HR pops in, and other people who, where it's good to have face-to-face communications are in the office, so it's quite productive.
Yeah, no, it's definitely good to be back in Sydney now with the lockdowns easing. I know we're headed back into the office sort of November 1, but I'm still calling in from home. So, I'm sure you as a Sydney sider would enjoy the Swans poster in the background, but maybe some of our Melbourne viewers might not as much. Let's get into a bit more of the thick of it now, Kevin. So just for the listeners and people that might not have a great understanding of Whitehaven, could you give us an understanding of the business model of Whitehaven?
Sure. Look, Whitehaven Coal came about 20 odd years ago with a guy who left as the chairman of Oak Ridge Coal at that time, and he assembled some acreage in the Gunnedah Basin. And over the years we've really grown. We started out probably 500,000 tonnes of production a long time ago. When I started, we were about 4 million tonnes, which is 2013. We had Narrabri ramping up, Maules Creek coming online, and we've produced up to a maximum of about 23 million tonnes in a year of raw coal. So it's all out of the Gunnedah Basin. It's been a steady growth program over those years of quadrupling in production, clearly bringing on Narrabri and bringing on Maules Creek and ramping those up to their capacity has changed the business from what Keith Ross had in his mind in 1998, where we're moving to larger mines, longer lives, but predominantly we're playing in the high quality coal basin at Gunnedah. If you look at the plan you've got in front of you there, Aidan, the producing mines are Maules Creek, Tarrawonga, Narrabri, and Werris Creek. Werris Creek finishes in about 2023, 2024. Maules Creek runs out into the 2050s. Tarrawonga in the 2030s and Narrabri in the 2040s. So we've got a range of assets that have different mine lives. And we've got 2 projects there, one in the form of the Vickery Extension project that was just approved by the federal government in September. That's nice to see. It has about a 25-year mine life, and we bought the Winchester South project from Rio Tinto back in 2018, and that has about a 25-30-year mine life. If you look at us, Maules Creek was a Rio asset, Vickery was a Rio asset, and Winchester South was a Rio asset. So I'd hate to say we're picking up the pieces that Rio didn't want, but it looks like it, and we're quite happy with it, to be honest.
Yeah, sure. And so that further line that you've got going through that slide, is that sort of the railway that goes down through into Newcastle that then ships out across the world?
Yep, Aidan, a really good question. I think we're about 380 kilometres from the coast at Narrabri and Maules Creek. It's about the same, and all that coal goes down the line, over the range, down into the coal network down in the Hunter Valley, and out through 2 ports in PWCS and NCIG. So we've got about 14 million tonnes of capacity at NCIG, about 9 million tonnes at PWCS, and it's a nice blend of port capacity where one is a cargo assembly port, which is PWCS, but NCIG with that 14 million tonnes lets us disconnect the rail, the production and the railing from the sales. So we've got about 700,000 tonnes of capacity at the port with NCIG, and that's a really helpful for us. So when we're not loading at WCS, we can move trains onto an NCIG and just load in advance, rail into Newcastle in advance of those boats turning up. And that's what helps us with port and rail and take or pay in those businesses. So it's quite a useful structure.
Yeah, it's definitely a good location to be a part of, on that New South Wales side especially. And so I'll just move on to sort of the next question now. So you know, on that side there, you've got Whitehaven Coal shipped to premium Asian markets. Could you give us a further insight into which Asian countries that you actually sort of move into?
Did you want to just roll us over a slide if you don't mind, Aidan? Because I think this is, yeah, the way to, and we've got a couple here. One will deal with the volume and one will deal with the locations, but really most of our coal goes into those high-end markets in Japan, Korea, Taiwan. But we're seeing emerging markets in Southeast Asia across Indonesia, Malaysia. We expect to see it in Vietnam. We've seen it in the Philippines, and we're actually in New Caledonia. We're selling high-quality, low-phos coal into nickel smelters in Indonesia. That's a growing market. Indonesia's trying to ensure that more material is processed domestically there, and they're producing a better product. So we see growth in that market. We see growth in the Southeast Asian nations for high-quality thermal coal, because if you put a better quality coal through a better quality power station, you end up with lower emissions than if you put a lower quality coal through a low quality power stations. And all the power stations that we're supplying to are HELE plants, and all the countries that we supply to are signatories to the Paris Accord, except Taiwan, which isn't a country by itself, but abides by the Paris Accord requirements anyway. So we're really exposed, I think, and exposed is not the right word. We really have the opportunity of playing with and fueling the growth in Southeast Asia. So you've seen 70 years of economic growth post-World War I, or post-World War II rather. That growth has been really represented in JKT. Now you're seeing Southeast Asian nations on that same path, a little bit behind the northern nations, and you're seeing India coming behind that. So we really do see ourselves as providing the energy and providing the raw materials for growth across Southeast Asia, across those Asian nations. It's where we are. We're the beginning of the supply chain for Asia, or Asia supply chain. That's the way to think about it. We expect to see growth in those markets, but really it's driven, as economies grow, demand for energy rises. I mean, if you asked your grandmother what her power usage was 40 or 50 years ago, it's a lot less than the power usage today. And it's the same thing in every other country around the globe. As countries develop, they put a fridge in, they turn the air conditioning on, they get a second fridge, they get a television. You're going to move to renewable power in the form of electric vehicles. So we expect to see across Asia, and that's certainly what the IEA says as well, we expect to see growth in Asia. About the only thing that can, not the only thing, one of the ways the NZE 2050 has some fairly startling numbers for coal demand, but that net zero emissions 2050 argument requires a carbon tax broadly across all the developed nations in 2030 at about $130 a tonne, rising to about $250 a tonne in 2050. That's probably the story that doesn't really get a lot of airplay from people talking about the demise of coal.
Sure. And just on this graph here, I'd just like to, sorry, you go if you've got more to say there. So on India, sorry, yeah, you guys.
I was going to say, it's a really good story, because what you see there in Japan is we have all but two, I think, of the JPUs in Japan. We're spread across the met coal steel producers in there. We've got 6 customers in Korea and Taiwan. There's really only 2 in Taiwan, but we have them both. And we've seen 2 of the 4 Indian steel producers. So we're in pretty good shape, I think, from distribution. And they're all, very high quality counterparties.
Mm. And so on India, so you've got 2 suppliers there with metallurgical coal, one of the fastest, largest growing economies in the world. Is there potential for thermal coal to be pushed into India, or is it a bit larger focus on the metallurgical coal side?
Look, our focus into Indonesia is metallurgical coal. We expect to see India do much the same as China in terms of developing economy, industrialization, urbanization. The requirement for steel in those growing economies should mirror China, perhaps a little slower than China, because China was a centrally planned economy. But we see 1.4 billion people in India being lifted or their economic standards being lifted, and certainly an emerging middle class and rising demand for metallurgical coal. We think that's a 2020 to a 2040 story. You know, it's not a turn it on much like China did between 1999 and 2008, say, but we really do see this as steady growth in that period.
Sure.
On the thermal coal front, Aidan, generally the Indian plants, the Indian market, domestic product, is a pretty ordinary quality. It's somewhere between 28 and 5400 kcal, 2800 and 5400 kcal. And the consumption of it is located geographically away from its production, so there's a fair requirement to move that material on the rail. So we think there's a demand in India for thermal coal, but probably not our thermal coal. I think that's why you're seeing Adani, for instance, in North Queensland, which is really a vertically integrated power company, is the way to think about that. And if their demand for energy mirrors China over time, and domestically they struggle to produce it, because today 4 years ago they produced about 700 million tonnes. They're seeking to produce 1.5 million tonnes. Sorry, 1.5 billion tonnes. But if they mirror China in terms of energy growth, they'll put tremendous pressure on coal prices as they grow.
Yeah, okay, I guess that's good for your business model then, regardless if you're sort of focusing on them as thermal coal compared to the rest of the market, bumps up the price as a whole.
It does. It's a bit like when China steps into the market, and when China was chasing lots of tonnes, coal prices took off. So it's a very similar. You know, we don't sell coal into China. If you go to the next slide, I think this will show you where the coal goes and the breakup from it. So you can see this, about what's that? 28, 38, 46, 84% of coal goes into Japan, Korea, Taiwan. So heavily in there. We are seeing in those markets, Aidan, we're seeing, whilst they're developed economies, we are seeing those markets swing to a better quality coal. So in Japan, for instance, there's a program of replacing old subcritical power stations with HELE plants on the same industrial site, and that's helping Japan achieve its targets or its Paris Accord commitments in reducing emissions. If you go to Korea is actually trying to produce buy at certain times of the year a really low sulfur coal, so it improves its air quality. And if you go to Taiwan, historically the markets were very interesting. Japan 6,000, Korea and Taiwan were lesser grades. Now you're watching Taiwan try and compete, or is competing for Japan for the 6,000 kcal quality. So we're seeing competition in that 6,000 kcal market from people who are stepping up in their quality requirements. Again, if I showed you, if you look at see the other, and you see the Thailand and New Caledonia, those Asian markets, if you saw that slide back in 2014, that would have been a slither. So really, those markets are growing and will continue to grow, and our expectations are they'll continue to grow for a while because they are emerging Southeast Asian nations with requirements for increased energy. Go over on the met coal. Sorry, go on.
Yeah, met coal was where I wanted to focus in on. In terms of construction growth in those countries that you're working with, and this slide speaks into that, how much of your sales in the met coal space is based on construction booming, obviously important in the production of steel in those nations?
Really, at the moment, we're seeing less demand for our semi-soft. Strong demand for PCI, but less demand for our semi-soft as steel producers are trying to maximise blast furnace productivity. So they're putting more hard coke into the mix and maximising blast furnace productivity. But what you see on this graph here is, 2020 was a year that really no one expected. I mean, we all left 2019, no one had heard of Wuhan, and no one had heard of the coronavirus. But the collapse in GDP, or the collapse in industrial activity in 2020, was largely COVID driven. Then we came out of that, and what we've seen is a coordinated upswing across the developed world as economies as governments have tried to stimulate their economy up. And we've really seen strong demand in industrial activity, strong demand in energy requirements, and that's against a backdrop where there's almost been no supply response from the nations out of Australia. There's been some supply constraints or supply chain constraints in a lot of countries. Australia, Newcastle last year, South Africa with issues at Richards Bay, Indonesia with flooding. So it's really been and Cerrejón with some issues on mines that have been closed down, and again on opening things up. So there's really not been much supply response against a really strong demand response, and that's why we've seen coal prices rise. You know, from they're about $120 or $130 in June, and they went 150, 170, 190, 240 odd today in the Newcastle GC Nuke market, and you've seen hard coking coal prices rise from $100 6 months ago to now being over $400 a tonne. So all that industrial activity is just driving demand against a constrained or a very slow supply side response, and that's driven prices where they are. And it's not just coal. I mean, if you take JKM, the Japan Korea market price for LNG at mid-30s, that's almost the equivalent of $900 a tonne. There's 25 megajoules of energy in a tonne of 6,000 kcal coal. And if you take that $35 and multiply by 25, you get to about $900 energy equivalent. So coal at 240 is still cheaper, much cheaper, and probably more freely available, well, not at the moment, than compared with LNG.
Okay, well, thanks for giving us an insight into the growth of those nations and how the coal market plays into that. So the countries that we're speaking about at the moment, are they sort of trying to move away from thermal coal? Obviously, we've spoken about it being cheaper now, but do you guys at Whitehaven sort of, look long term, that 2030, 2040 mark that you were talking about before, and consider what those nations are going to be doing?
Aidan, yeah, we do. We're one of the first companies, or we were the first pure play coal company to do TCFD reporting. We're members of the Coal Industry Advisory Board, which advises the IEA on the coal markets over as part of the World Energy Outlook. We're on the World Coal Association, which helps us with those conversations. We're in with the Minerals Council, dealing with other coal miners, and we sit down and we unpack the WEO every year. We unpack BP's economic analysis, and we form some views as to where coal is going. But probably, the other thing that we have that they don't have is that we have joint venture partners and customers, and we have an insight into where our customers are seeking those coals, and we join all of those up. If I look at WEO 2020, and I haven't read WEO 2021, that came out last week, but it's only 386 pages of light reading, so we'll get to it. But I'm assuming, I'm expecting that what I'm expecting out of all of that is that the world's on track for something close to the stated economic policies, which is all about how does coal support or provide for itself over the next 20 or 30 years. And there's a lot of chat around NZE 2050, Net Zero Emissions 2050, and how that happens. But I think in that document, the IEA says this is one path, not the path, but that's been broadly read to be this is the only path you can adopt. And coal in those periods, what we see is customers who are, as a first step, seeking to use a better quality coal and a better quality power station while they transition to something, over a period of time. But Asia has the youngest coal-fired power stations on the planet, and our expectations are that will continue to be a source of demand for years to come. As I said before, the fundamental principle underpinning NZE 2050 is there's a carbon tax in developed nations of $130 a tonne in 2030, rising to $250 in 2050. And I struggle to see how we see that get coordinated across the globe. It's different countries with different economic standards in different points in time being asked to adopt something that basically slows down their economic growth. When you look at Europe and the USA, and two completely different stories. The decline of coal in Europe has really been driven by policy and policy support, so that's government support. And in the US, the decline of coal in the US really was a function of the rate of technological advance in drilling and completing unconventional gas wells and unconventional oil wells. So as that changed, that drove the price of gas from, you know, in 2007, I think gas was about $14 a million BTU in the US, and drove it down to under $2. So really the economics in the US drove that change. In Southeast Asia, you don't have the same competing principles. You don't have a developed economy that can afford to endorse or implement the policy support that Europe's been able to implement, and they don't have access to the same cheap gas that the US has. So from that perspective, coal remains a really competitive product in Southeast Asia.
Yeah, it's good that you are thinking about that and working that out long term. It'd be relatively concerning if you weren't at the end of the day. And then, you know, sort of moving back onto, you know, the larger business model. What's the sort of balance between both thermal and metallurgical coal at the moment at Whitehaven Coal?
Historically, we've been around the 20-25% met coal, and that was up until the beginning of COVID. When COVID kicked in, that number is probably now down in the early teens for met coal. But as a group, in 2018, we bought Winchester South from Rio Tinto. We've got a Victory project that is a very good quality semi-soft and very good quality thermal coal. Our expectations are over 2030, over the decade to 2030, with the development of those projects, the decline of Werris Creek dropping out, our expectations are we'll end up around a 50-50 met coal thermal mix. So we'll grow our met coal mix, and that's really where we're spending if we were to spend money on those projects in the years to come, and we intend to, then those projects will bring more met coal into the mix of Whitehaven Coal. And that's our game plan. In the last quarter, I think the numbers were somewhere around 11% for met coal. So it's really, as I said before, that steel producers are working hard to maximise steel production out of the blast furnaces, and that's led to an increase in hard coke rather than the semi-soft coking coal that we produce.
Sure. So other than Winchester as the project there to increase that production, is there anything else in the woodwork that you can give insight into at the moment?
Really can't. I've got the Vickery project there, which we think is 50-50 semi-soft, and we see those developing. We see that need growing as India grows. So as India grows over 2020, 2030, then the demand for that semi-soft and semi-hard coking coal and the PCI products that will come out of Queensland should be aligned to the growth out of India. And that's where we see that coming from. We see that steel production that traditionally was Japan, Korea, moved into China, now moving into places like Vietnam and moving over into developing nations, as the developed Asian countries are offshoring their own steel production. So our expectations are that demand grows over the next decade, and that's why the alignment of those projects, they are aligned to that met coal growth in that region.
Yeah, definitely. And sort of moving forward now, in terms of looking back at what you've done in the last 12 months, you know, what were your sort of full year 2021 results? What were sort of the highlights for you as the CFO?
I think, you know, 2021 was probably one of the toughest years I think we've had in business. You know, we came into, I had a holiday in Australia in 2020, came back to the country, we were cutting budgets, and sat down with Paul and said, we don't know where this thing's going to finish, it's going to get harder than we think it's going to be, so we turned down capital, you know, we worked hard at reducing costs. I had an analyst tell me I was going to raise $400 million in capital because I needed it in August. And I think over the year we went from $638 million drawn on the facility to $688 million drawn on the facility at the end of it. So we navigating through 2021 was and coming out of it the way we came out of it, really well positioned and taking advantage of that in FY22 with the increase in coal price. Probably been the toughest year I've seen in business in a long, long time. You know, because that COVID thing was. Because COVID was not like a normal economic downturn where you can see it coming over time and you know what caused it and you can point to when it's going to turn around. COVID was unusual as to how it arrived and how we were going to get out of it. So we naturally took a really cautious stand there in terms of trying to preserve capital and manage the business through the bottom of that cycle. You know, post year end, post 1 July, we're retiring debt at a great rate of knots. We expect to be net retiring the revolver completely very early in the calendar year 22, and just following the half year results. And we expect to be net debt or net cash, which means I've got about $60 million in ECA facilities and about $180 million in leases. So I'm expecting to have something like $300 million of cash on the balance sheet by the end of the, somewhere in that March quarter. So it's really been a strong period since the end of that year. In that result year, EBITDA was down from FY20 from 305 million to 200, and really that was all driven by coal price falling out of bed with COVID, and by the FX really, unusually, the FX strengthened in that period. I mean, ordinarily when commodity prices come off, the Aussie dollar comes off, but it didn't. So it wasn't our friend at all. And even though coal prices rallied at the back end of the year, the FX was probably the thing that hurt us the most.
Yeah, it was interesting. The Aussie dollar dropped very, very low in certain points in COVID. I think it got sort of 55 US cents, but it bounced back strongly, sitting around 75 today. Would you believe it? And so this coming year, there's a forecast of around 35%, annual growth. What sort of things, obviously there's a COVID change that's happening. You've done quite well to manage that situation. What things are going to reach that result now with that 35% in this coming year?
Look, I think the current year is going to be an absolute cracker, would be the way I'd say it. It's we've got record coal prices. We're seeing a little bit of pressure on costs from things like diesel prices. You get a little bit more demurrage, but we're talking about a buck or two. That's about it. And what we're seeing is a coal price that is going to see us, on my numbers, we're going to generate something like $900 million or $800 million in cash between 1 July and very early in that very early after year end. Half year end rather. So, with a strong second half, we've got better coal quality in the second half because Narrabri's moved on to 110. We've got a full half of production from Narrabri. We've got generally a stronger half of production from Werris Creek and Tarrawonga in the second half. And we've got really strong coal prices. Even at today's $240 US, the margins in that are just astounding, is the way to say it. And so I think when people see the first half results, if it stays the way we think it's going to play, we're set for a record year, which is it's not just tweaking past the records of 17 and 18. It's leaving them well in the dust. So it's a really strong year. We see strong demand for the product. We've got customers trying to advance cargoes out of January and February into December. That tells you the market's really tight. You still see a price, if you wanted to buy coal on GC Nuke, physical coal on GC Nuke, not just settled paper, that premium today was about $6 2 or 3 months ago. It's now heading up towards $10. So people are short coal and people are short energy, and we're really seeing that in the price of coal. We're really seeing that in the price of coal. We've got a strong second half coming. And really looking forward to a great result for the year. After fiscal year 21 and the difficulties of that, it's nice to be the CFO of a coal company that's bringing cash.
And so in that answering of the question, there's a lot focused on the actual wider coal market and the global economy rebounding and that demand for energy and coal. In terms of what your controllables are at Whitehaven Coal, what is it that you guys will be focusing on to make sure you achieve those results?
Look, the number one thing we've really focused on over the last 6 months has really been getting our planning for COVID right. We've introduced a whole range of things that really I'd say we've been well managed and lucky. We're in a great region, not close to an urban environment. We haven't had any interruptions from COVID. We look at the state opening up, and we've got plans in place to ensure that we're managing through that for the next 2 months while that unfolds, because the opportunity for that to go south or pear-shaped is quite open. But moving through 2022, what we're really working on is making sure that you know, when we say something, we return to the position we had a few years ago where we said we give guidance and we delivered on the guidance. So we're looking at delivering on ROM production guidance. We're looking at delivering on our sales tons. Our sales tons, you know, you look at there's a nice slide I saw this morning that said there's an 8% energy difference between API 5, which is 5,500 kcal, and 6,000 kcal, but there's a 70% premium. There's a 70% difference in revenue. So to the extent we can, we're working hard, and that, you know, in the first half with Narrabri tons, we're trading at about, or selling coal at about 15% discount to Nuke, that and the lag in the product mix. In the second half, we're looking to be a GC Nuke plus realizations. So those are the two things that we can focus on, which is really delivering quality, delivering tons, doing it consistently, and making sure that what we say we actually deliver. And from that, you build a platform where you can improve the business, and that's the program that we're running in Strive in Whitehaven at the moment. It's delivering value for us. It's really embedding in the business a culture of continuous improvement and control. And I know that sounds strange after we've been listed for 13 years, but this is the transformation of a company that was really a small business into being a big business. And when it brings on other operations that will be larger, we really do need to have discipline in that process to ensure that what we're saying we're going to do is what we actually do.
So a lot of it's focused on making sure that the plans you have now in your operations come to fruition. And so I might just go a little bit, you know, sort of asking a question outside of this now. In terms of who's running the operations at Whitehaven Coal, and can you give some insight into their experience maybe?
Sure, happy to. Look, the guy running the EGM, I go back in. There was a structural change in the business in 2019 where the COO at the time, that role was split into three. So it was split into a head of HR, a head of health, safety and environment, and an operations focus. So we brought Ian Humphries in from Peabody, who is running the operations. And under him, he has a number of people. He has a general manager of each site. He's got a fellow called Dean Scott starting at Gunnedah, who is looking after, following a fellow called Bernie O'Neill, who's had 46 years in the industry out of Queensland and is a really solid operator. I've got a guy at Moles Creek called Jorge Moraga, who's a Chilean. He's ex-BHP, who brings process and discipline to that. And what you see at Moles Creek now, I saw a note this morning that said, you know, Moles Creek's running into its 13 million tonne approval limit, which is really the discipline that's being brought to that business. And at Narrabri, what we've got is a fellow called Gerald Lind, who worked under the previous general manager there for 6 or 7 years. So we've got fairly solid management and a good team there. The real difference is not the real difference, one of the real benefits of changing that structure is being we've now got a lot more focus on environmental compliance, which was a weakness we had through 17, 18, 19. Our improvement in that is quite stark in terms of how we're performing post that change in 2019. And our HR team is equally as important because we need people that can operate and are committed to getting their efforts for Whitehaven. So really good changes, good team structure, led by Paul Flynn, who's been in the business since 2012, I think, as the director of Whitehaven, 2013 as the CEO. Looking forward to a solid year and looking forward to Whitehaven's continued growth, you know, over the next decade.
Well, it's obviously would have been a very hard change in 2019, and then everyone has to go through 2020 and sort of, you know, hit the ground running, so to speak. But now that those plans are in place and, you know, the operations are set up with what sounds like a very strong management team there, you know, hopefully the results in 2022, you know, very strong moving forward. And what I'm just going to sort of focus on now is sort of back on the economic side of things. So, you know, last month it would have been nearly impossible for anyone in the industry to not notice, you know, BHP and Fortescue, they're dropping share price because of the coal share price and their relationship with China. And so, you know, we saw before that you actually have a minimal exportation to China, if any. But I'm curious as to, you know, does that impact of the geopolitical tensions between Australia and China have a larger impact on the coal price and in turn affect you at Whitehaven Coal?
The global energy complex is really interrelated. It's a great question. I mean, yeah, we've got some customers who have a capacity to substitute gas for coal. We've got customers who can buy down the quality or up the quality depending upon what's happening with prices at different grades. And procurement officers understand the capacities or the limitations of the equipment they've got installed, and they're happy to do that. You know, China does influence coal prices, largely because it used to take something like 300 million tonnes of coal out of the seaborne coal market, about 100 of that in met and about 200 of that in thermal. Post 2018, I'd probably say what happened in coal was in middle of 2018, you started to see that trade tension between US and China tried to produce more coal for itself and become less reliant on the seaborne coal market. Yet fast forward that to 2020, hadn't been terribly successful in growing the tonnes, turned on a really big stimulus from about February 2020, and really skyrocketed its needs for energy against the backdrop of not being able to get coal from Australia. Back half of the year, other countries started to come out of COVID. They turned on the taps. They wanted to stimulate their economies. Demand just took off from about October through to the last 12 months. So China does influence, because if China can't source it from Australia, it then sticks its paws out and buys coal from Indonesia, from Russia. It'll even buy coal from South America. And what it does serve to do is it muddles up freight rates, because boats are on the water for longer where otherwise they go somewhere else, and it generally just drives the price of energy up. And so when China's there, it does that. But if I said to you today that China's trying to limit its coal price to 1,800 yuan per tonne, and at about 6 yuan to $1, that's about the equivalent of $300 a tonne for 5,500 kcal coal. That same coal out of Australia is about $110 to $120. So China does influence coal prices, but it's not. We're not seeing. We as Australians aren't really seeing that in all its glory, because we're seeing the 5,500 market being depressed because China's not buying out of Australia, but we're seeing 3,800 kcal out of Indonesia being priced at 140 bucks. Go figure that out. So lower energy, closer to home, but coming at a bigger price. So the dysfunction in the market, I think the coal prices as they stand today are really just a reflection of China not in the market on the API 5, because otherwise that spread back to GC Nuke would be a lot closer. And you've got all these other economies that are chasing coal. It's not like China's calling us up and saying they want coal, because they're not. We've never sold a ton of thermal coal to China, much as I wouldn't mind doing that, because I'd be very happy selling 6,000 kcal at GC Nuke. Just one sitting in China would keep me really happy. But that's not how it works. And met coal, they bought semi-soft from us in 2015-16 as malls ramped up, but since then really haven't. So really the demand for our product, the demand for Australia product is ex-China. And that tells you that those economies are going very strongly. And the JKM market price for LNG tells you those economies are going very strongly. And so while China does impact it, the overriding thing at the moment is the strength you're seeing across that line there that says 6% increase in industrial activity, followed by 4%, followed by 3%. So my view here is that the strength of the recovery underpins these coal prices for a little bit longer than people are expecting.
And it's interesting sometimes, you know, as Australians, we can read the news and hear that, you know, China is no longer buying Australian coal, and instantly you think, well, you know, the coal price is going to drop down. China now have no use for coal. But the thing is, they still have the exact same amount of demand. They're just sourcing it elsewhere, and so that, you know, still bumps up the price. And so then Whitehaven Coal already got the relationships outside of China, built in India, Japan, Korea, can still focus in on those areas without being as affected by those sort of price changes, so to speak.
Yeah, no, it's right. And you know, I mean, Australian out of Newcastle, there's about 55 million tonnes goes out of NCIG. There's about 110 million tonnes goes out PWCS. So there's about 160 million tonnes, and that's predominantly semi-soft, PCI and thermal. China produces something like 3.8, 3.9 billion tonnes of coal a year. So a lot of its coal needs can satisfy itself. It's the coal on the coast, the coastal cities that rely on imports and were designed that way, and it's the coastal steel mills that rely on imported coal. So there's a bit of dysfunction taking place in China, but it's a big country. It's got economic activity and economic growth taking off. They've got a growth agenda, and they've done really well, I'd say, over the last 30 years. If you go back to 1990, if you ask somebody in 1990 where they thought China would be in 2020, I'll guarantee you it's not where they are today. So they've done really well in 30 years, and they've still got a huge population that they want to lift lift the living standards for them. So my expectations again are, or our expectations again, are that China will remain a rational buyer. It'll seek energy in the market. Those emerging economies in Southeast Asia and across towards across India, those countries are going to require increased energy. You know, for that to change requires pretty much the globe to adopt the IEA's, the IEA's model for carbon tax, and I think that's going to be that'll become clear over the next decade. But our expectation is that 2020s, 2030s, and we would expect technology will change, and emissions will be reduced. That's not something that happens in 2 years or 5 years. That's something that happens over a decade or 2 decades or 3 decades. And to expect that that's going to happen across the globe in a decade, I think is fanciful. And I really think that net zero emissions 2050, that pathway is through technological change. And there's a lot of work being done offshore around this, but it's at pilot stage, not at commercial. Commercials in the 2030s, and then rollout is 2040s and 2050s. So I don't see the death of coal in Asia anytime soon, and I know that's going to create some angst for some people. I'm probably going to get commented upon badly, but that for some people have different views. But that's how I think this plays out. You've got a growing economy, range of growing economies, and a range of countries who are seeking to lift the living standards of people, and coal has lifted the living standards of all the people in the developed world. It's the developing world that wants the same things that the developed world has. So that's what's going on here. Technology will change, but those changes across a global platform aren't done quickly, and they require, I think the numbers Goldie's put out the other week was something like it's a $60 trillion investment, and the carbon tax business is a $5 to $10 trillion per annum sort of number. So we're not talking about insubstantial, trivial changes.
Yeah, and at the end of the day, whilst you said you might ruffle some feathers there, it is a reality in the sense of, whilst in Australia we're very privileged, if you go over to India, who will be, most likely the largest importer of coal moving forward in the next 10 years and potentially longer, their vaccination rate right now is at 22%. One of the largest populations in the world as well. And you think, well, can they really afford to be paying carbon tax and looking elsewhere to grow and sort of make their economy healthy for their people? Or are they going to take the cheapest option with coal? And so for that, 20-year block, let's call it 2020 to 2040, they're going to focus in there. And whilst that, does, sit hardly for many Australians and potential investors out there, there's a reality that those countries, they're in poverty and they need this resource to grow their economy. So yeah, there's that sort of reality in the market too.
And I had the fortune to spend some time in India, again with like the Coal Preparation Society of India, which you'd find to be a strange name, but they were building something like 60 coal preparation plants. They have some great universities. I honestly do think, man will solve this issue through technology. They won't solve it through taxation. And there's some really smart people. What I've seen through the Coal Industry Advisory Board and different places I've been to with that is there's some really motivated and smart people who are working on this case. But their timelines aren't 2025. Their timelines are 2035 to 2050. And it's that sort of that's the reality, I think, in terms of how does technology play in the space.
Yeah, and that's the market that we see for the next sort of 15 to 20 years. And I guess, my concern, as an investor or advising people to invest in the market, is that, price can be considered king at the moment. So the best example is, Afterpay, but no profit, no nothing. It's all forecasted long term. Whitehaven Coal in the next 15 years could, do 10 times the profit of Afterpay. But because the Australian market is so focused on ESG investing, what actually happens to the price of the share of Whitehaven? It could have the best dividend ever, the actual share price could be low. So can you speak into that a little bit potentially?
I can't talk about Afterpay. My wife poked me in the eye. She said, "I understand this. This is called, widespread lay-by." And I said, "I don't understand it." Anyway, so I don't understand Afterpay, but it seems to be. I wish I did a year ago. From my perspective, I look at this and I go, last 5 years we've generated $3.3 billion in EBITDA. And if I take a 5-year view of this thing, then I think I'm riding out some of the hills and the hollows in terms of coal price. If I do that, I look at us and I go, this year I'm likely to lift that average quite a lot, right? And next year I can't see myself being below average, because in fiscal year 23, because you look at the slide here that says in 22 you're going to have 4% industrial activity, 3% in 23, and the trend before that you're only getting back to on trend in 2024. So I think that demand for energy in these emerging nations across Southeast Asia, as has been described by most of the commentators, remains intact. Their economic growth continues, their demand for energy continues. The alternate forms of energy for them aren't dense enough to underpin the economic growth they're looking at. And so I think this business, when we do our TCFD studies, we say this business is resilient through that process. And I go back to my earlier comment, which says that net zero emissions 2050 price deck that pops out is driven, the coal price deck and the coal price demand in there is driven by the fact that the underlying assumption is $130 carbon tax in 2030 and a $230 to $250 carbon tax in the developed world. And even in there, they're saying there's a carbon tax in places like Russia, China, Brazil, and South Africa by 2030. So it's that for me. I look at it and say, I think coal has a role to play in years to come. Technology will displace it, otherwise we'd still be killing whales and burning lots of trees in New South Wales, and we're not. So technology will replace it, but I don't think it fits the timeline people are talking about, because the pilot to commercial to global rollout isn't a decade-long experience. So I'm really positive about the whole. I'm really positive about coal for this and Whitehaven and its quality. I mean, Whitehaven's quality is, when we started Maules, our major concern was, would we be able to sell all the coal we produced? And by the time we shipped samples and opened up trial cargoes, we were very pleasantly surprised at the rate of take up in Japan. And today we could sell as much coal as we could produce. We could sell into those developed nations, just because it is very high quality, very clean coal.
We've got I'll go to live questions now. There's a lot coming through. A lot of them, there are certain questions about the buyback, and some of those we're going to need to ignore, to be honest. It's not really the time and place. But maybe in terms of a better way to maybe ask this is, after you've sort of paid off your debt within Whitehaven Coal, and you'll have more excess funds, you've spoken about investing in metallurgical coal. A shareholder's going to get a kickback in the form of a dividend. What's sort of your outlook there, across the next couple of years, hopefully?
Look, our take on it is that all of those forms of capital management are on the table. I mean, we should. My expectation is that we will pay tax on the fiscal year 22 earnings, because the tax losses that we have will, if not, there's an element of them that are allocatable fractions that just take forever to get rid of, but we will have chewed up most of our tax losses in the first half of this year. We'll have a tax payable out of the second half of the year. And that means in December, we will have put money in a franking account. So I know some shareholders don't like unfranked dividends. Some shareholders just like dividends. And I know some shareholders push for a buyback. I think all those things are on the table. The thing you won't find us doing is a buyback with an elevated share price. We have a view on, I think what we're saying to you is we have a view on value, and you know, when the share price really takes off, that doesn't make a lot of sense to me in a commodity market to be buying your shares back at elevated prices. But certainly, you know, what we really would have loved to have done, Aidan, is, you know, be in a position such that in 2020, when the share price hit 87 cents, that we were rolling into the buyback quite strongly. And so I think what you're going to see us do is give shareholders a drink in the form of a dividend. Consider the buyback option where that delivers real value to us. Retain some strength on the balance sheet, such that we're not viewed as being a come equity raise at any point in time in the cycle, and that leaves us with the ability to respond to an inevitable commodity price decline at some point in time in the future, and a share price that follows it.
Okay, I've got another question. Sorry, you go. Continue.
No, you're right.
Yeah, just in terms of time, it's probably good to roll through a few of these questions from shareholders and viewers. One of them is sort of asking about, once these tax breaks that we've been speaking about in terms of the carbon tax on coal in 2030 and 2050, and this question is probably, thinking about the reality of this is unlikely, but what can sort of Whitehaven Coal do to manage, the expectation of the global market looking to reduce their use of coal?
I think what Whitehaven can do is probably articulate its strategy around Scope 1 and Scope 2 emissions more clearly, and that's coming together. I mean, we own 70,000 hectares in the Gunnedah Basin. The OEMs are talking regularly around what their next generation piece of equipment is going to be. So I think, reducing emissions Scope 1, Scope 2, that they're within our control, and you'll see us do work to align behind a government strategy, because we are a compliant Australian company, and that's where we'll get to. On Scope 3 emissions offshore, all these countries that we sell to are parties to the Paris Accord, and coal factors in the Japanese version of how it gets to net zero emissions in 2050. It factors in the plans of Taiwan and Korea, and it factors in the markets in Southeast Asia that we're selling to. What we can do is continue to produce a high quality product, continue to support the regional economies in which we work, and continue to work with the government on how we achieve, Australia's objectives when those objectives become articulated.
Okay, no, thanks. I think to start out, I dropped out for a moment in terms of the connection. Hopefully the viewers got the brunt of it. This question is sort of looking at the major competitors in Australia, and Fortescue, BHP, they're named there. Do you think they're going to focus their efforts in on China, Japan and Korea, which would have a larger impact on your own sales distribution, or do you think they'll still have a larger focus on China?
Well, we're selling met coal into Japan, Korea, Taiwan, Vietnam, and India. Fortescue's basically selling its iron ore into China. BHP is selling its met coal into the markets that we sell into, and its iron ore into China. We see ourselves as really tied to that industrial activity. When steel mills are producing lots of steel, they're consuming lots of energy. So that's where our thermal coal goes. When they're producing steel, they're consuming the PCI product. And our semi-soft. And as years go on, as we introduce more met coal into the mix, we expect we'll be supplying that metallurgical coal into those markets and the emerging markets across India. So I don't know that we're competing with those two companies as such, but we are in similar markets, which is really the industrial energy or the industrial complex and the beginning of the supply chain in Southeast Asia.
Yeah, I wonder if that question was sort of focused on, the iron ore production moving into those countries with high steel production. Is their steel production going to maintain, so their iron ore importation remains sort of flat through that period? And sort of where are they getting that iron ore? I think maybe where that question was headed more.
Yeah, I think I don't sell iron ore. The last numbers I saw for iron ore were that China didn't become reliant or didn't become self-sufficient, or its self-sufficiency by recycling was a fair few decades away there as well. So there's a World Steel Association that has all of those stats that's well and truly available if you go have a look at it, and they really do some good analysis on where each of those countries are up to in terms of basic blast furnace production versus electric arc and all the recycled steel products that come out of that.
Yeah, and I think that question is sort of quite far advanced in terms of in the production of steel, you need both iron ore, met, and whilst Whitehaven is providing the met, do the buyers still have the access to iron ore over the long term? But yeah, in some ways, it's sort of hard for you to determine, and that person can go have a look at that website. I'm sure that'd be great.
It is hard. The other thing that anecdotally, when we talk to some of our customers, and we've got some of the major steel producers. The green steel was after 2050, between 2050 and 2100, and it was to the end of that period, not the beginning of it, when all of that the majors were talking about. So again, I go back to the earlier conversation around rate of change in technology, what technology is coming down the pipe, how that gets rolled out from pilot to commercial and globalized and replaces global capacity. Those things are they're not within a decade, they're multi-decade programs. And so I still see iron ore and met coal being used to generate steel. I think the focus out of the carbon capture storage group within the IEA is on how does the world change processes and abate emissions reductions in steel production, in cement production, and in other places, in other industries like that. So that's really a focus on how do you actually solve some of those hard to abate emissions, and there's work being done on that. And again, I think that's the work I'm seeing says it's 2030, 2040 for carbon capture storage abatement there, but replacement, I think anyone who's talking about replacing with green steel on a competitive basis in the 2020s is, I'd like to see the research. I'd just like to see the research.
Yeah, sure. And just before we head off, Kevin, one last question here. What is Whitehaven's hedging approach through periods of high coal prices, i.e. during the upcoming Northern Hemisphere winter?
We'd like to put a little bit more away at $260. I don't think there's anyone in the industry wouldn't like to do that. But the way we like to do that is not in the hedge book. We don't go into the hedge market. We go and deal with end customers, and we've got contracts that will allow us to do that. Traditionally, over a year, we will have about somewhere between 25 and 30% of what we sell, we will have sold forward. And if we do that over time, we'll generally get the average. So today we're looking to try and do a little bit more of that, but we don't really step into the paper hedge program. And as much as I'd like to say that that's a deep market, it's not. You turn up in that market, and the deeper market is the API2 market out of Europe, but that has a lot of differences than the GC Nuke market into which we sell. So when you do that, you've got some basis exposure, and you've got a lot of other fundamentals driving price differently in Europe, i.e. you have a carbon tax in Europe, you don't have one in Asia. So we try not to do that. We try to do that with customers, and we're working at putting a few more tons away at these prices by dealing with customers.
Yeah, okay. It's a very dangerous game to get into the hedge game with commodities, so it's better to focus your efforts on the production of the coal.
And every time I've gone
long term, and some people.
Yeah. Every time I've gone on hedge diesel, I've woken up with a hangover, so it's not a good story. So we've got a long life mine. I'll say this less clearly than that. We have long life mines. We produce consistently over the year. We're going to sell into the process over the year. It'd be nice to think that we could hedge more of it and pick the top of the market, but that becomes problematic, I think. I think 240, 250.
Cool, we might leave it there today.
All right. Listen,
Oh,
thank
sorry,
you very
Kevin,
much.
I cut you off there. My internet was.
So listen, thanks very much for the conversation, and I look forward to it. And I hope your listeners aren't going to go away too offended, and look forward to doing it again.
Yeah, no, thanks so much for coming on. And for anyone whose questions didn't get answered, feel free to send me or the team an email. We'll do our best to answer them. And thanks so much, Kevin, for coming on board and giving us a great insight into Whitehaven Coal and what you're going to be doing in the future.
All right. Thanks very much.
All right. Thanks, Kevin. Have a great one.
You too.